cash in the business, build up a lot of cash, be profitable, and if all the divisions fire at the same time, you obviously will get a better result. I think the main achievement would be the cash flow. That's improved substantially. A couple of years ago, the business was a little bit in financial stress, and we had to bond and lend a lot of funds. But subsequently, with a profitable situation, we have managed to push our cash up by about 258%, which gave us a good cash reserve of 17.3 million. So we're pretty proud of that. For the last 3 years, we were concentrating mainly on making sure that we get the internal structure correct, save as much cost as we can, and then make sure that we can be in a position where we are now, where we can utilize that cash, and when the infrastructure is right, to actually expand the business. That's what we were looking for. So last year we had a discontinued operation, 2.5 million rand, which hurt us, but fortunately management took a quick decision to close that division before it hurt us too much. The longer you take to take such a decision to close a division, the more costly it becomes. So there was a quick decision, it was closed out. So in this year's results, that 2.5 million rand is a clear improvement on the results itself. Then the bottom line, 7.2 million rand profit after tax. I think it's reasonably impressive based on the turnover. Compared to last year, 2.2 million, taking into consideration continued and discontinued operations. The reflection shows a 177% increase in profit after tax. Now, we think that's quite an achievement, and for a technology sector such as ours, going through difficult times a couple of years ago, the company's shown a vast improvement in the last 3 years. On the commercial side, profitable on the EBIT line. Defence, obviously the champion, running at about 74% of our total profit before tax, making a substantial contribution to the bottom line. And then we've got the CCS division, brand new division, first year, million rand profit. We're very proud of that. That got off the ground, did some beautiful sales, nice sales, and that's where we got our profit from. So, but yes, once again, segmental turnover is very much similar again, which is definitely a concern. We need to have a look at more expansion to create better bottom line. The company is now structured in a position where we're financially strong, and we're actively involved in mergers and acquisitions. We're looking at various opportunities. And on the 1st of July, we merged with Radiant Antennas. We actually didn't merge them, we bought their business. So it was a going concern buyout, and we think there'll definitely be some benefits from that deal. I think if we can achieve a top-line turnover increase on a profitable companies, and you look at a possible return of 7 or 8%, you can well look at those figures. But mergers take time, and they must be properly planned, proper due diligence done to make sure that you don't buy something that's going to cost you money. So I would say yes. I wouldn't say in the next 12 months, immediate improvement, but definitely in the long term, there must be improvement, there will be. At the moment, we've got sufficient cash to declare a dividend, but management and the holding company has taken a decision not to proceed on a dividend at this stage yet. Rather use the money, invest it, merge, and build a better capital base, and declare dividends thereafter. So that's the only reason. It's also a very short term since we've come out of a very negative situation, then a very small profit margins, and now we bring to more substantial profits, which is acceptable in the market. But it's only like the first year, so I would assume a dividend policy definitely for next year. On the balance sheet side, we were very fortunate with the additional cash flow that we received to settle a lot of our liabilities. We had funding from the IDC, and we could actually go to the IDC and tell them to cancel those facilities. That took all of the securities that they had on the company before. There would be debtors book and sureties from the directors that were waived, and they moved that along. In addition to that, we could settle some of our long-term funding, which was a management decision to make sure that we could save a bit of interest on that portion, and also make sure that we don't just let the cash lie in the bank and not work for us. And by doing that, we freed up new possibilities for the company by cancelling some sureties again. We are very confident in our balance sheet. One of the major issues, as well as the intangible assets, we've managed to, notwithstanding a lot of capitalization during the course of the year, to bring the value down constantly every single year. So a decrease in liabilities, a decrease in long-term liabilities, almost a cap on intangible asset value, all strong, positive current asset value ratios. So the company is definitely doing better. Stock also a little bit less than the prior year. All of that contributing to a strong, healthy cash flow balance. Regarding the current share price, it remains to be seen if the market believes in the 12 PE compared to the company's net asset value. So we don't track that much on the share price. We're more interested in growing the company, showing capital growth, long-term sustainability, and making sure that we give good returns to our shareholders.